For many developers and business owners seeking 7 or 8 figures, this is where progress stalls. This is also where private loans and other private funds can change the story. Across Canada and the United States, there is a deep pool of private capital ready to finance commercial real estate, operating companies, and complex projects ranging from $1 million to $500 million. These private loans come from non-bank lenders, pension funds, insurance companies, family offices, and specialized funds that evaluate opportunities differently than traditional banks. Instead of relying strictly on rigid underwriting checklists, they focus on asset strength, project viability, and clearly defined exit strategies. Private funding extends well beyond simple term loans. Asset-based lending, mezzanine debt, project finance, and construction facilities all fall under the broader umbrella of private capital. When structured correctly, these tools enable businesses to acquire properties, expand operations, manage cash flow, and execute large-scale developments that banks may hesitate to support. Equus Capital Finance has spent more than 2 decades connecting clients to this segment of the market, particularly within the non-bank lending space. Acting as a boutique capital advisory firm, Equus structures and presents transactions so they receive serious attention from private lenders across North America. The result is less red tape and more actionable financing options. As Walter Wriston, former CEO of Citicorp, once observed, capital goes where it is welcome and stays where it is well treated. This principle remains highly relevant in today's capital markets. By understanding how private loans function, how they differ from traditional bank financing, and what it takes to qualify, borrowers gain a clearer path forward. This vlog outlines the types of private funding available, the application process, how to select the right lender, and how Equus Capital Finance helps turn complex financing needs into successfully funded transactions. What are private loans and how do they differ from traditional bank financing? In a commercial context, private loans are capital solutions provided by non-traditional lenders such as private funds, mortgage investment corporations, insurance companies, pension funds, family offices, and specialized finance firms. These lenders operate outside the regulatory constraints that govern banks, allowing them greater flexibility in evaluating opportunities. Traditional banks typically rely on historical financial performance, strict ratio requirements, and long-established credit histories. For businesses that are growing rapidly, undergoing transitions, or pursuing complex projects, these criteria can create barriers. Private lenders, on the other hand, approach transactions differently. They place greater emphasis on asset value, projected cash flow, contractual revenue streams, and the overall strength of the business or project. The modern private lending market has evolved significantly and is no longer limited to distressed situations. Many experienced developers and business owners choose private capital even when they qualify for bank financing. They do so to access larger loan amounts, benefit from faster approvals, or secure structures that better align with their strategic objectives. Naturally, this flexibility comes with a trade-off. Private loans generally carry higher interest rates than traditional bank loans, reflecting the increased risk and adaptability provided by lenders. However, for many borrowers, the speed, certainty, and structuring flexibility more than justify the cost. Types of private funding options available in Canada. Private capital in Canada encompasses a wide range of financing structures designed to support different business needs. One of the most common forms is asset-based lending, where funding is secured against tangible assets such as receivables, inventory, equipment, or real estate. This approach allows businesses to unlock liquidity tied up in their balance sheets without selling assets, making it particularly useful for managing working capital or funding large orders. Another key structure is mezzanine or subordinated financing, which sits between senior debt and equity in the capital stack. This type of funding is often used when a borrower has reached the limits of conventional senior financing but still requires additional capital. Mezzanine debt typically carries higher interest rates and may include some form of equity participation, but it enables borrowers to proceed without significantly diluting ownership. Project finance and construction loans represent another major category within private capital. These structures are based primarily on the future cash flow and value of a specific project rather than the borrower's overall balance sheet. Common in real estate development, infrastructure, and industrial projects, these facilities are often advanced in stages and tailored to match construction timelines and milestones. Who qualifies for private loans in Canada? One of the defining advantages of private lending is its flexibility in qualification criteria. Unlike banks, private lenders are not bound by a single standardized policy framework. Instead, they evaluate each transaction individually, focusing on whether the overall risk is justified by the collateral, business plan, and exit strategy. Credit history still plays a role, but private lenders are generally more willing to consider borrowers with past challenges if the current situation is stable and the transaction is well structured. They look beyond simple credit scores and examine the broader financial picture, including payment history, business trajectory, and the reasons behind any prior issues. Collateral quality is often central to the decision-making process. Strong real estate assets, valuable equipment, or high-quality receivables can significantly enhance a borrower's ability to secure financing. Additionally, a well-developed business plan with realistic financial projections and a clear path to repayment is critical. Management experience also carries considerable weight. Lenders place confidence in teams that have successfully executed similar projects or demonstrated strong operational capabilities. Ultimately, qualification depends on presenting a coherent, credible story supported by tangible assets and a viable financial structure. Strategic uses of private capital for business growth. Private capital is not merely a fallback option when bank financing is unavailable. It is a strategic tool that enables businesses to act decisively in competitive environments. One of its most common applications is in commercial real estate acquisition and development, where speed is often critical. Private lenders can close transactions quickly, allowing investors to secure properties and execute value-add strategies before transitioning to long-term financing. Operating businesses also rely on private capital to support expansion initiatives. Whether opening new locations, acquiring competitors, or investing in equipment, private financing provides the flexibility to pursue growth without being constrained by rigid lending criteria. Repayment structures can often be tailored to align with business cycles, reducing strain on cash flow. In addition, private capital plays a vital role in working capital management. Asset-based lines of credit and flexible facilities allow businesses to manage receivables, inventory, and operational expenses more effectively. This is particularly important for companies with seasonal fluctuations or large contract-based revenue streams. How to choose the right private lender. Selecting the right private lender is a critical component of a successful transaction. Different lenders specialize in different asset classes, deal sizes, and risk profiles, making it essential to align the financing partner with the specific requirements of the project. A lender's track record and specialization should be carefully evaluated, as experience within a particular sector often translates into better understanding and smoother execution. Access to capital is equally important, as lenders with multiple funding sources tend to offer greater stability and more competitive terms. Speed and execution capability are also key considerations. In many cases, The ability to close quickly determines whether a transaction proceeds or is lost to another party. Flexibility in structuring and a problem-solving mindset are particularly valuable in complex or non-standard deals. Finally, borrowers should look beyond headline interest rates and consider the full scope of terms, including fees, covenants, prepayment conditions, and overall flexibility. A well-structured loan with slightly higher pricing may ultimately deliver greater value than a restrictive lower-cost alternative. The private loan application process. The process of securing private financing is typically more collaborative and efficient than traditional bank lending. It begins with an initial consultation, where the borrower and advisor assess the viability of the transaction and identify the most appropriate structure. Once the deal is deemed viable, the focus shifts to documentation and due diligence. This includes financial statements, projections, collateral details, and supporting documentation relevant to the transaction. Private lenders conduct their own analysis, testing assumptions and evaluating risk. If the lender is satisfied, a term sheet is issued outlining the proposed terms of the financing. This stage often involves negotiation to refine pricing, structure, and conditions. Following acceptance, legal documentation is finalized, and the transaction proceeds to closing. In well-prepared cases, this entire process can be completed within 3 to 6 weeks. Advantages of working with a specialized financing advisor. Navigating the private capital markets requires experience, relationships, and strategic insight. A specialized advisor such as Equus Capital Finance acts as a capital architect, designing financing structures that align with both borrower objectives and lender expectations. One of the primary advantages is access to a broad network of lenders, many of whom do not actively market their services. This increases the likelihood of finding the right match for a transaction. Advisors also bring expertise in structuring and packaging deals, ensuring that they are presented in a way that resonates with lenders. Additionally, advisors strengthen negotiation positioning by introducing competitive dynamics and leveraging market knowledge. They manage the process from start to finish, allowing borrowers to focus on their core operations while ensuring that the transaction progresses efficiently. Private funds and private loans represent a powerful and strategic component of modern capital markets. They provide businesses, developers, and project sponsors with access to flexible, timely financing solutions that extend beyond the limitations of traditional banks. Rather than serving as a last resort, private capital enables growth, supports complex projects, and creates opportunities that might otherwise remain out of reach. With loan sizes ranging from $1 million to $500 million, these solutions are applicable across a wide range of industries and transaction types. In a market where speed, structure, and certainty are increasingly important, private capital offers a decisive advantage. When paired with the expertise and network of a firm like Equus Capital Finance, it becomes a highly effective tool for turning ambitious plans into executed transactions.